Hi everyone, this is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I followed his work for years. I've seen him on interviews with Chris Martenson. I've read his pieces over at Oil Price in the past. He's an energy specialist and keynote speaker with 37 years of experience in petroleum exploration and production. He has a much longer resume that I will link to in his bio in the information section of the interview. Art Berman, thank you for joining me today.
Pleasure to be here.
Now, Art, I want your opinion on the oil market. Do you think the oil market's in a bear market right now?
The sentiment is certainly bearish. The price that we've got right now, right around the mid 40s, is really about where it ought to be based on technical information, supply, demand, inventory, etc. So there's nothing about mid 40s that I think is low or high for that matter. And I think what has to be, the context has to be established. So what happened was we were, at like $43 a barrel a year ago when OPEC finally, looked like they were gonna do something. They made their cuts back in November. We were at 43 then, I'm sorry. And the price went up, and it went up based on absolute vapor, just expectation that, if OPEC cuts production, then that's going to raise prices. And that situation persisted for about 6 months, what I call an expectation premium. And then, beginning in June, the market started to realize what I guess I'd been telling people and writing about on my blog for some time. This thing doesn't have any legs, and so the market figured that out, and the price started to fall, and it basically has fallen right back down to where it was before the cuts were announced. So, we got 6 months of higher prices, which I guess was good for OPEC certainly, and now we're back to where we started. So. Is that a bear market? No, I think it's just, we got an inflated market based on, sentiment, expectation, and now it deflated right back down to where it was before all this stuff started.
Do you think then that OPEC is going to actually stick to their cuts, or do you think that there's going to be wide-scale cheating? Because the past history of OPEC, sticking to cuts, not cheating, is very high. I've seen a lot of stories of Libya, Nigeria, Iran, Iraq are either already increasing production, they're exempt from these OPEC cuts, or they want to increase production further in the near future, despite this low oil price below $50 a barrel.
Right. Well, so nobody expected OPEC to even initially meet its commitments, and a lot of people, including me, were surprised that they did for up until they extended their cuts. Now you talk about Libya and Nigeria. They weren't covered by the cuts, so they were free to do what they wanted. And those two countries have increased production about 700,000 barrels a day here just in the last few months. So that doesn't represent cheating, but it takes a big chunk out of the effect of the cuts by the other members. But I think the important thing is it looks right now like the agreement's kind of falling apart, that the level of meeting cuts was in the 90 percentile range. As of last month, it's down below 80%, and so kind of looks like things are falling apart. So and Russia has clearly said they're not a part of OPEC, of course, but they're a big part of this agreement. They said we're not interested in cutting any further, and that took a little bit of the wind out of the market. So you're right. OPEC has a pretty bad track record of following through, and I think the likelihood of another year is I don't place a lot of likelihood on it. Let's put it that way.
Yeah, because while a lot of OPEC producers, including the Saudis, do have low production costs, they also are almost entirely reliant on oil and natural gas for their budgets, for all their government spending, all their social programs. And we know that these governments are hurting financially. Whether it's Venezuela is not doing well financially, the Saudis are even talking about floating this Saudi Aramco IPO. Why do you think they're willing to do this IPO? Do they really need the cash for something else?
Well, there's a couple of reasons, but I think that this is just Art Berman speculating right here. But I think they know the truth about the longevity of some of these old fields like Gawar. I mean, the biggest field in the world. And they keep saying, "Oh, this thing is going great, and it's going to keep on going forever." Well, those of us who know anything about oil know that there's no way. And so, I suspect that they're, and I don't have any doubt that they're gonna do an IPO on some portion of Saudi Aramco, and I think they're going to do it now before it becomes evident that they can't keep up the production. I mean, everything in nature, including you and me. I mean, we grow to a certain point, we level off, and then we decline. That's the way the earth works and everything on it. And oil fields work the same way. And as far as I know, they haven't made any big discoveries over there in a long time. So eventually, it's got to decline. So that's what I think. That's my guess, but it's just a guess. Nobody knows.
Yeah, all oil fields eventually peak, whether they're Cantarell in Mexico, Gawar, like you said. I think the Saudis are using a lot of water. They're cutting their production with a lot of water, and I think that's a red flag to people that they're having to do that to keep production levels where they are.
Well, they've been having to do all kinds of very expensive, what we call pressure support, secondary recovery for years. So, and that's standard operating procedure in the oil field. So there's nothing new about that. It just says that once you start doing that, then that the end is, I don't want to say the end is near because these things take a long time, but I just think that the spare capacity that they have is very, very limited to non-existent right now, and most of what they have that they're not pumping is it's not good oil. It's very heavy oil. It's got a lot of hydrogen sulfide in it. There's basically no place to refine it. So they're going to tell you that spare capacity, but if you can't sell it, then what good is it?
That's a great point. And also what that means, since you've highlighted some of the techniques that they're having to use those things cost a lot more money. So their $10 per barrel production costs are sounding like fiction to me then too.
Well, for sure. I mean, that's a $10, that's what we call a lifting cost. I mean, that's just the cost of operating the well and everything around it. That doesn't count. I mean, there's all sorts of other costs involved, and that's something you really got to watch out for. Certainly not just with OPEC, but we got a lot of companies here in the United States that I think it was Pioneer Natural Resources made a big deal 6 or 8 months ago about how their production costs in the Permian Basin were comparable to Saudi Arabia. Well, what are they talking about? They're talking about the cost to operate the lease. They're not talking about the cost of the well. They're not talking about, what they have to pay employees. They're not talking about taxes, and they're not talking about any of that stuff. So what does that number mean? Well, it doesn't really mean a heck of a lot. If you look at their
sorry to interrupt you.
Look at their
how much of their costs then do you think they're leaving out when they give out that? Are they leaving out more than 70% of their costs then?
Oh, sure. Yeah. I mean, just to throw out a round number, I think that their break even cost in the best part of the Permian Basin is probably $40 or $45. But so that $10 is like a 20% of their total cost. But I went and looked at, they have to file these financial forms with the Securities and Exchange Commission every quarter. Every public company in the U.S. does. And at the time, their production costs were considerably higher than $10, and I don't remember what the number was. I think it was like $15 or $16, and that's because the Permian Basin isn't the only place they have wells. They've got wells in, the Eagle Ford Shale and all that, and when you average it all together, it turned out that number not only was low to what they stated, which doesn't mean that they're wrong about that, but there's no way to verify that number because they're not required to provide specific numbers on production costs in the Permian Basin. So it's basically, it's a way of wowing investors, hoping they're going to, give them money. That's what it's all about.
That's excellent. I wanted to transition then to exactly that point. When I've interviewed other oil experts in the past, and they tell me now that Wall Street loves the Permian Basin because basically, you don't spend a lot of money on exploration budget and risk hitting a well that misses. You hit a lot of winners. Cash flow can be quick. You can increase production very quickly. Do you think there's a lot of misallocation of capital then going into oil and gas, into the Permian and other shale plays that are not going to be able to be paid back by these companies? Do you think they're going to be able to pay back their debt and generate free cash flow in the future?
Well, they're not generating free cash flow now. That's a real problem, and this is something I've tried to point out for many years about these shale gas and tight oil plays. That I got nothing in the world against the plays, and I don't have any investments that cause me to either benefit or suffer from their success or failure. So, that's not what I do. I'm not that kind of an investor. But ever since go, when oil prices were $100 a barrel and gas prices were $12 per thousand cubic feet, these companies had negative cash flow. And again, it's public data. You can just get on Google Finance or Yahoo Finance and take a look. What did they spend on capital expenditures, and what was the cash from operations? And it's always negative, and it always has been. So all this talk about how they're making a bundle of money, well, okay, but somehow it magically never shows up on their income statements and their balance sheets, and I think that's kind of a problem. And the reason, just to cut right to it, the reason is that when they tell you they're breaking even at these ridiculously low prices, $30, $35, they're excluding all kinds of costs. Just like I was telling you before, if you don't include the cost of paying your employees and keeping the lights on and, having corporate jets and all that, well, okay, that's money that you're not counting. If you're not counting interest expense on all the money that you've borrowed, well, as long as you're honest about that and you make sure everybody understands, well, I guess that's okay. But, that's like me saying that I make X number of dollars a year, and oh, by the way, and my disposable income is Y, but that doesn't include my mortgage payment, that doesn't include my car payments, that doesn't include my student loans, and you're going to say, well, what does it mean? That's stupid, and that's what they're all doing. So when you include, and I'm just including legitimate costs of doing business. Okay, I'm not counting sunk costs on leases, even though I really should. But when you actually include everything that it takes to stay in business, and I know because I'm in this business, I'm not a financial analyst, I'm not a journalist, I'm not a pundit. I'm in the oil and gas business. That's what I do for a living. I drill wells, I make maps. I know what those costs are. And when you add all that stuff up, I think Goldman Sachs published a graph just this week in which they said these shale plays need at least $50 a barrel, and I totally agree with that. So back to your question. The problem, I think, with the Permian Basin, it's a good play, okay, but it's not universally good. There's some sweet spots, as they always are, and if you happen to have land right in the core of those sweet spots, and that's all you got, then you're probably gonna do okay. But the problem, as I see it, is that when everybody has the same idea and everybody is all trying to get into the same play in the same basin, well, that almost guarantees that nobody's going to make any money. I mean, they're just paying way too much for land. I mean, some of these lease costs are up to like $60,000 an acre. I mean, that's just insanity. And so, whenever everybody decides this is it, then that it's already over in some ways. At least that's my observation on investments in general, not just oil and gas.
Yeah, I remember a few years ago how the Bakken and Eagle Ford were being talked up about how great they are, but it seems, Art, based on the data, that a lot of these, the main wells there, the sweet spots, have already peaked, and it was less than a decade. So, the Eagle Ford is the next great play for production, for production growth. What worried me was, I don't know if you saw this article, like 2 months ago on oil price, there was an article talking about how excited CEOs in the Permian and other shale plays were to go into bankruptcy, raise more capital out of bankruptcy, how easy they had access to capital, and then start growing production again. So when I read articles like that and see examples of CEOs talking about this in their conference calls, this really worries me about the long-term health of a market.
Well, you're right. And so what worries me is, they say that, but the fact that investors don't see through it, or maybe they do, and they've got some other motive that causes them to go into, whatever they're doing, buying, high yield corporate bonds or junk bonds, or, buying shares. I don't know what causes them to do it. And I mean, maybe they're looking out there into the future and they're seeing that we're not investing nearly enough money in exploration and production. And a couple of years out, there's going to be tight supply, and prices are going to go up. And of course, I mean, Saudi Aramco says that, and Schlumberger says that, and the International Energy Agency says that. So you don't have to be a genius. It's not like a unique insight that that's probably going to happen not too many years out into the future. And Chris Martenson, he and I talked about that the last time he interviewed me. No one knows when it's going to happen, but it's going to happen. So, maybe you put money into these companies because when that does happen, then you think you're gonna strike it rich.
Yeah, these national oil companies, Art, and as well as the large private sector oil companies, there's been hundreds of billions of dollars in capex cuts in the last 5 or 6 years. And so long term, there's going to be ramifications for that. But these national oil companies, they're not reinvesting their oil profits back into their oil businesses. So they're not plowing the money back into, improve their refineries, exploration. The money's not going there. It's being spent to, keep their governments running and for social programs. So long term, there's going to be ramifications for that on oil supply for that as well.
Definitely. And there was just an article this week in Bloomberg talking about how, whether it's national oil companies or just regular private oil, public companies, private companies, because of all the budget cutting, I mean, they're not doing the kinds of maintenance that they should on existing fields, and the decline rates of existing fields have almost doubled over the last couple of years. So, we're losing proven, established production because companies and countries aren't spending what it takes to keep it up. I mean, we're not talking about drilling new wells. We're just talking about, you need to take your car in every couple of months to make sure that it's in good shape. Well, they're not doing that.
Are those on just the shale plays, or are those also on conventional oil
that's
fields
on
too?
That Bloomberg article was on conventional production. So that's these are very, I mean, none of this surprises me and shouldn't surprise anyone. When times are hard, when you're not making a lot of revenue, you're going to cut wherever you can, and you're going to sacrifice the long term for the short term. I mean, that's not necessarily bad business, but as you say, it'll have ramifications, and the ramifications will be severe when they finally come home to roost, so to speak.
Do you think?
I think go ahead. Sorry.
do you think at the current oil price, do you think then we're going to see a lot of bankruptcies then in deepwater offshore, whether they're the submersible companies like Transocean and others, or Seadrill, or the producers who are mostly deepwater, or the oil sands companies then, because they can't lower their costs like the shale guys have been able to?
Well, if you read the press, I mean, they're all saying that they're so ingenious, that they've using, some combination of ingenuity and technology. Everybody says that they're now doing great at these lower prices. But the truth is that no one is. No one is, no one can. Not the shale companies, not the offshore guys. I mean, it's just what's happened more than anything else, Jason, is that, I mean, the oil business is in a deflationary spiral right now. And we can, talk about why that happened, but that's what's gone on. And so, I mean, the cost of drilling wells, just to use one important measure, and there's a producer price index for that, by the way, that the St. Louis Fed publishes. I mean, anybody can go look at this. I mean, the price of drilling an oil and gas well in the United States has decreased by 45% since 2014. So, and I think that's very indicative of all service, not just rigs. And I know that because I'm drilling wells. And so if everything costs half as much as it did in 2014, well, duh. You can do just as well at $50 oil as you did at $100 oil. That doesn't have anything to do with technology or ingenuity. That's got to do with everything costs less. And you talk about these service companies, Seadrill and whatever. I mean, they've had to slash what they charge companies just to keep. They need the business. I know. I mean, I talk to companies all the time. They're so competitive trying to get our business, undercutting each other, and they just need the cash flow. That's what it comes down to. Even if they're losing money, they at least can get the cash flow, stay alive another day.
Yeah, I was actually going to ask you about that, about the onshore drillers, service companies offering 15 to 20% discounts routinely for the last couple of years just to get anyone to drill wells. So you think then that they're going to probably start, now that they're starting to get their order books increased, they've been getting more orders, they can start raising prices again?
Well, they have, in fact. But here's the rub and the disconnect. And so we say that, that oil prices are, $45 or, whatever they are today. But that's not what you get. It's $46, $46.04, at least that's what the NYMEX is right now. But that's not what you get at the wellhead. Okay. First of all, that's NYMEX and that's not spot, but okay. But just to give you an example, I mean, if you're in the Bakken play, what's actually paid at the wellhead right now is probably, $37. If you're in the Permian Basin, what's paid right now is probably $42. Okay, there's always some discount that the guy in the field never gets the posted price. And so you say, well, it's a couple of dollars. Well, yeah, but that's 10% in the case of the Permian. And so if everybody's saying, well, we can make money at $50, well, what's that really mean? I mean, can you, if you got 50, that'd be super. But if you're only getting 45 or 46, are you still making money? And I don't know if I believe you when you say you're making money at 50. So that's something that most people just don't understand. And it's different for every basin. And some of it has to do with transportation costs, and some of it just has to do with infrastructure. I mean, if there's a limited amount of infrastructure, pipelines and whatnot to take away the oil, well, then the pipelines can drive a hard bargain because people need cash flow.
Those are great points about the industry. Yeah, that it seems that the costs have temporarily gone down for a while, but that was just for reasons that you outlined with the service companies desperate for business. I want to talk now. You did a great interview, long interview, 2 parts with hedge fund manager Erik Townsend. You outlined kind of the during the interview. I'll put a link to it for our listeners, but you talked about the Saudi strategy to try to bankrupt U.S. shale oil producers 2 or 3 years ago. Why do you think that failed?
Okay, well, first of all, I don't think that was their intention, and I know that I'm in a huge minority here in taking that opinion. But let's just back up then and talk about it. I mean, we in the United States are extremely America-centric. Okay, and so we, meaning journalists and analysts and whoever, have created this narrative that the Saudis and OPEC didn't rescue the world from lower oil prices back in 2014 because it was a war against the U.S. shale industry. Okay, now there's absolutely no substance or support for that argument. That's just that's the narrative that everybody's told, and now, I'm not naive, and let's face it. I mean, it was the shale companies and their overproduction that caused, at least initially, prices to go down. But again, Saudi has never said why they did it or why they didn't do it. And when I look at it, I mean, it makes perfect sense to me. If I were in their position, and the price was going down because there was too much production, I could say, well, gee, I and we at OPEC could cut a few million barrels a day, and maybe that would cause the price to go back up. But who's going to benefit from that? Well, the same shale guys that caused the problem to begin with. And who suffers as a result of cutting production? Well, we do. We get less revenue and we lose market share when we cut our production. So we're giving a gift to the same guys that caused this problem to begin with. Why should we do that? Okay? So, I mean, that's really at the core of it. Now, the other thing that I think you have to understand is when OPEC cut like crazy back from 1981 to 1986, OPEC cut 14 million barrels a day in a market that only used 50 million barrels a day. And it didn't do a damn bit of good. They lost a ton of market share, they lost a ton of revenue, and oil prices didn't budge. And so finally in 1986 they said, forget that. We're going back to pumping. So my point is that I think their strategy in 2014 and going forward was principally guided by this simple directive. We're never going to make that mistake again. We're never going to cut to our detriment and have no effect whatsoever on oil price. And so again, I'm not trying to paint the Saudis as being good guys or anything, or bad guys for that matter, but I don't want to be painted as naive in this. I just think that as a business decision, it made sense. The business decision was, we don't think that we can affect the price of oil because there's so much overproduction on the market. So why should we hurt ourselves to no effect? That's what I think.
They initially didn't do production cuts, right? And it seemed they said the oil market was in balance a couple years ago. I'm trying to remember exactly what they said. And it knocked the oil price. A lot of people at that time thought that the shale oil needed 65 a barrel, and they knocked the oil to 65, and then the oil just collapsed below 65. And yet I thought a lot of shale producers would go bankrupt, and a lot of them actually didn't. I guess that's because they had hedges on their production of 2 or 3 years.
Well, some of it has to do with hedges, but the other part had to do with, with what we just talked about. That, and it wasn't. I mean, the price. I mean, let's remember that in the beginning of 2014 and through about June of 2014, oil prices were $100 a barrel. They didn't begin to fall until the middle of 2014, and it wasn't really until September that people started, taking notice. And so it was everybody, they'd fallen to maybe 70 or so by third quarter, and everyone knew that OPEC was going to have their meeting in November, And okay, well, they're going to save things for us. And when they didn't save things for us, that's when the bottom dropped out. But it wasn't engineered by OPEC. It was, I mean, that's where prices were going anyway. But again, there's this huge expectation premium that people expect that these guys are going to save us from our own sins. And when they didn't, then the bottom dropped out. But when I say the bottom dropped out, I mean, prices didn't go, they didn't go down to where they are right now for more than a little while. And we were back up to $60, $65 a barrel, during the first quarter of 2015. So things got a lot worse after that. It was really by the end of 2016 when prices were below $30. That's when OPEC started saying, geez, maybe we really do need to do something here. And they started talking about a freeze, and eventually it turned into a cut. But again, I might be way wrong here, Jason, but I think that OPEC, Saudi Arabia mainly, has taken an absolutely practical approach to what do we really think is going to happen if we do X, Y, and Z, and I think that they've judged that it wasn't worth it to them, and so what's happened now? Well, they did cut, and what did that do? It caused the rig count in the shale plays to go through the ceiling, and it's so what I suggested they might have been thinking a few years ago came true. They cut production, the price went up, and these guys can't keep their pants on. They got no discipline whatsoever. They go berserk, and what does that do? Well, eventually it drives the price down, which is where we are again. So that's the way I look at it. And again, I'm not criticizing really. I mean, I got my tongue in my cheek here. It doesn't really make sense to behave that way. But again, I think what people have to understand is that a lot of these oil companies, these shale players, they're not in business to make money. They're in business to get money. And if they can get investors to give them money, then they're going to spend it. And they tell a story, and they spin a yarn, and investors buy it and give them a couple of $1 billion in a few hours and a secondary share offering, and they're good, man. I mean, they're good until they need money again.
That sounds exactly like how technology stocks were sold during the technology bubble, where, they outline a strategy for revenue growth, but, no dividends, no free cash flow, no reinvestment back into the business. But, your shares are going to go up, we're going to grow revenue, and that's how we're going to keep raising capital to sell junk bonds and raise new shares and things like that.
It's the same model. And as long as it works, I mean, who can say it's the wrong model? I mean, I'm not going to put my money in something like that, but what works, okay, and it's worked. I mean, some of these companies, I mean, they went out what I just said. I mean, some of these guys they have a secondary share offering, and they open it up at 9 o'clock in the morning, and by 1 o'clock in the afternoon, they got $1.5 billion. These are not giant companies. I mean, that keeps them going for a long, and they don't have to pay anything back either. It's free money.
Well, yeah, Wall Street collects all the fees on these, so they love this too.
You bet. Well, the investment banks have to. I mean, they got to make those kind of arrangements, or they go out of business. So everybody is pursuing their own interests in the right way when you look at it on a small enough scale. It's when you zoom back and look at the whole thing that you say, my God, this is nuts.
Yeah, it seems incredibly myopic and short-sighted because, as you know, you've been in the oil business very, very long time. I've been an oil analyst for a while. But, the money is not being reinvested into capex to go find new deposits or improve technology for oil recovery or any of these things. The money seems to be, based on companies. Like I said, the companies are coming out of bankruptcy and they're raising capital. That was just a head scratcher to me. I don't think I've ever seen that before.
Well, they got no debt, so it's great, isn't it? Yeah.
It's a video game restart.
It is very similar. So, and again, I don't really expect people who aren't in the business as you and I are. I mean, how are they supposed to know all this stuff? And the answer is, well, it depends on who they are. So if you're just Joe Public and you're reading, what's in the local paper or the Wall Street Journal or whatever, then you have an opinion, okay? But I would think that investors would study the situation a little more carefully, and maybe they do. Like I said, and they're smart. Don't get me wrong. I respect them. I just don't understand the fascination, and well, I say I don't, but okay. So here is what I think is going on, and that is the piece of this that I know you understand this, but your listeners need to understand is that when the Federal Reserve Bank and the central banks of the world lowered interest rates to zero, or effectively zero, after the 2007-8 financial crisis and kept them there, I mean, that changes everything. So, everybody knows that you can't make any money in a savings account, and you can't make very much money in a treasury bond. So everybody who's smart is looking for, where can I get a better yield? Got to do it. Okay. Where can I get it? Well, our investment banker friends or private equity say, well, you can get it in the oil business. You can buy a high yield corporate bond. They'll give you 7%, 8%. And is it risky? Well, I mean, it's riskier than a treasury bond, but no, it's not really very risky. It's backed by a hard asset in the ground, and maybe these guys go bankrupt. Somebody will buy them, and as you just said, we've had a whole slew of bankruptcies, and most of those guys are still around. So it's not a totally dumb idea, right?
Yeah.
So
not only are they still around, they're talking about growing even faster right out of bankruptcy.
Absolutely. So so these investors and the people that advise them are not dumb. I mean, if they're getting 6 or 7%, they're beating the pants off of traditional investments. And I think, as I said before, these investors are smart, and if they could find someplace else that would get them that kind of yield at what they perceive to be a relatively low level of risk, they'd probably do it, but they can't find it. Real estate kind of went away on them. So, and maybe that's, a simplistic way of looking at it, but I think you have to, that is the reason. And so you have to also understand that the level of indebtedness, whether it's corporate debt or public debt, consumer debt in the world today, it has grown astronomically over the last 20 years. So everybody is feeling the crunch, whether you're a person, whether you're a corporation, whether you're a country. I mean, you got a lot of debt to service. And as I said before a couple of times, in the absence of making money, at least you get cash flow and you can service your debt. And I think that's a factor that is so important. When you're trying to understand, how did this happen and why does it keep on going? Why do OPEC members cheat? Well, part of it is they got bills to pay. They need the cash flow. So that's, there's more to it than that, but on a high level, that's something that people need to bear in mind all the time when they're trying to understand the situation.
Yeah, in a rational market, Art, if there weren't as many, I think, national oil companies or cheap bubble credit, artificially cheap credit, like you said, from the central banks available, in a rational oil market, when the oil prices were low, you would think supply would be cut. But a lot of the national oil companies didn't cut supply. They wanted to increase supply because they needed to make up their losses of cash flow on increased revenues. And then you have, with the uses of debt, you have large oil majors like ExxonMobil. Instead of, using debt maybe to go buy a smaller oil producer to add reserves, quality reserves, add maybe oil or natural gas production, they really didn't do that to a large extent. They've spent an enormous amount of debt, tens of billions, buying back their shares at higher stock prices than the current stock price.
and somebody probably had a really good argument as to why that was a good idea, or they wouldn't have done it. But does it serve the greater good of the market and investors? Well, it did, ExxonMobil shareholders, I'm sure. So
well,
it's complicated.
It's very complicated. Now, I want to ask you before I let you go about long-term demand for oil. I think the global economy is not doing very well. I think things are slowing down. Do you see demand for oil slowing down a lot? What's your view then on long-term demand for oil as well?
That's a really good question. And so I do an inordinate amount of work trying to understand demand way back before agencies provide that data and even out into the future. And here's the bottom line, that over the last 30 years, world oil demand has increased about 1.2 million barrels a day like clockwork. Some years it's a little higher, some years a little lower, but and that trend has not yet shown any sign of changing. Okay, that's a fact. So you hear all this stuff about peak demand, about all the reasons why, and the oil companies like Shell and some of the others that they fret about peak demand and all this. But the truth, and maybe they're right, but it's a forecast, it's a prediction. There's no evidence yet that says that demand is diminishing. And in fact, just this morning, the IEA published their oil monthly report, and they've now upgraded their demand forecast for 2017 to 1.4 million barrels a day, which is, it's more than the 1.2 that's been the 30-year average. And it's a little bit less than it was last year. It was about 1.5, but that's strong. So the answer is, I'm sure peak demand is somewhere out there, but I would not recommend that anybody base their investments on some notion of peak demand or diminishing demand until somebody can show them that it's happening, or that there are reasons to expect it. Now, the big reason, of course, that most people read about and hear about is, all these, these electric vehicles are just gonna, they're just gonna kick the wind out of the sails of petroleum, and I get that, and there's no doubt that electric vehicles and renewable energy are gonna. They're going to play an increasingly important role in the mix as we go forward. But wait a minute. Let's sit back and take a look at this thing. Renewable energy in the United States accounts for about 3% of our total energy consumption, and in electricity, which doesn't include transportation or any of that, it's about 7%. And if you look at, let's say you go out and you buy an EV, you go buy a Tesla, and you feel really good about yourself, because you're helping the environment and all that. Well, where does the electricity come from that you use to charge your Tesla? 2/3 of it comes from coal and natural gas. Okay, and I just told you 7% maybe comes from wind and solar. So there's a heck of a lot of fossil fuel, oil and gas plus coal use and costs that's embedded in all of these things that people say are going to cause the end of the end of the petroleum age. So it's just not as simple as that. It's first of all, these things have to get some traction. I saw the other day that Singapore cut its tax subsidies for electric vehicles, and the month before they sold something like 4,000 Teslas, and last month they sold 0. Okay. Now again, I'm not trying to argue against those technologies. I'm all for them, I'm just trying to make people aware of the fact that there's no evidence to date that those kinds of things are going to cause oil demand to fall on its face anytime in the near future. So
Yeah,
if I had to say, I'd say, well, sure, the oil demand will slowly decline over some period of time. Maybe in 10 years we'll look back and maybe it's down to 1.1 million barrels a day or 1 million barrel a day, and that would be important. But I just don't see that. I think the biggest threat to oil demand is what you said before: is if the global economy doesn't get its act together, and if it actually gets worse, that'll hurt demand for not just oil but everything else. If we have some sort of a major recession like we did in 2009, well, boy, every commodity, including oil, the demand for that went way down. So I'm a lot more worried about the sustainability of the global economy than I am about electric vehicles stealing a big market share in the near term from oil. And again, I'm not being partisan here. I'm not trying to argue. I don't have a book in this. That's just what I see.
Yeah, I don't think demand for oil is going to collapse unless, in the near term, unless the economy totally collapses like in 2008. And even then, the demand for oil will probably still rebound pretty quickly because people need to go to work and things like that. But a Bank of America oil analyst recently said that U.S. gasoline demand collapsed since February 2017. It's down 6% and even more during the summer. Basically says no summer driving season. I wouldn't say that means that long-term oil demand is collapsing. I would probably say that's more of an economic indicator, a leading indicator maybe, that the real economy in the U.S. is through the government data is heading towards a really bad recession then.
Well, and you know more about that than I do. I would say that 1 month is a data point, not a trend. So let's see how that forecast holds up.
Oh, well, it's since February, and it's accelerating more over the summer now. So, it's been like 6 months, almost 6 months now.
Okay.
So it's trending downward. So I think then maybe people then do not want to, they're filling up their cars less, maybe trying to save some bucks here or there. And people remember, if you remember, like the mainstream financial media was saying, oh, this low oil price is going to be a economic stimulus. People are going to go out and spend a lot more money on a lot of other things. They're going to go out and drive more, and that really hasn't happened.
Well, it did happen. It absolutely happened in 2016. The vehicle miles traveled reached an all-time high. I'm looking at the Federal Reserve Bank of St. Louis right now, and I'm seeing April 2017 is a giant number, like 3,177,000. If we go back to, it looks to me like it's flattening, but I haven't downloaded the data, but that I'm not seeing what the Bank of America guys seeing. It's not obvious right here.
Yeah,
I'm looking at January, February, March, April. And April's the last month they've got. I'm not, like I say, it's flattening a little bit, but I don't see that it's declining.
Yeah, I think you're making an interesting point there, that there's conflicting reports out there.
Yeah.
Look on the front page of the oil price, it says super majors are talking about spooked by peak oil demand. So.
Well, like I say, I just went straight to the, this is the fred.stlouisfed.org, and clicked on total vehicle miles traveled, and I'd have to analyze it a little bit closer than just looking at the graph that they've got on their website. But I'm able to put my mouse on these months, and I would say that April is higher than February. So I'm not seeing what that guy's talking about, but maybe he knows more than I do.
Yeah, I haven't looked at it, so I can't really comment on that. But it seems that oil with the price action is range bound, and it does seem like oil is struggling to stay above 50, especially when the U.S. oil producers have just kept increasing production. We haven't seen the rig count fall an enormous amount recently. So unless that stops and production in the U.S. From the Permian and other places starts to rapidly fall, there's going to be supply kind of preventing a larger oil price rally, I think.
Well, oil prices are definitely range bound. We had this conversation a month or so ago. I would have said the range boundaries are 45 to 55. It looks now like the lower range boundary is still kind of tentatively maybe 45, but 50 probably looks like kind of a higher sustainable range boundary. The Energy Information Agency of the Department of Energy came out with their short-term energy outlook Tuesday, and their forecast out to 2018, December 2018. I think they're calling for $53 oil. And that it's a forecast, and it's wrong. We know that, but there's just not a lot of optimistic information. There's sentiment, but then there's information, and I think the EIA does a pretty good job of trying to integrate all that economic outlook along with supply and demand. That's just my take on it. But yeah, I'm looking here, and it looks to me like vehicle miles traveled. February was higher than January. Looks like March was higher by less than February, and April, which is the last month they got data for, is higher than every other month in 2017, but it probably is flattening.
Last question before I let you go. Do you think as an investor people should be looking to put money into the oil market, or do you think this is a dangerous time to invest capital into any oil investments?
Well, if you can get if you're in it for other than purely speculative reasons, I mean, if ExxonMobil or some company like that, if their price gets low enough, I think, and I'm not pushing their stock, I'm just using them as an example, that's the kind of thing that you might pick up on. I mean, not that you're going to get rich off of it, but those companies aren't going out of business. And all the oil companies' stock prices have slid hugely in the last couple of months. So if you like a company based on their assets and their management and their track record, and you can pick it up for a bargain right now, that makes sense to me at least. But overall, I mean, you're looking at a market that we just discussed is its commodity is pretty much range bound, and there's not a lot of reason to expect that to change. So probably investors by dumping energy stocks, they're probably doing the right thing. They're saying, look, we can get better returns in other sectors, and that's probably true. That is true.
Yeah, in the short term, I think that's probably true. I expect a lot more volatility in the short term for sure. But I would like to see, the companies, I know the management teams at a lot of companies aren't doing this, but it seems whether they're the large oil companies or the mid-tier independent ones in the Permian and others, seems they're not focused on the right things to build a quality company long term. They're all focused on the short term. And so, long-term investors then are going to be hung out to dry, and people, in the short term will do well.
Well, yeah. So like I said earlier, a lot of these companies are in business to get money and not necessarily to make money, and they've been successful at that. And investors ought to be, they ought to, if their eyes aren't open to that, they ought to try to get them open and focus on the companies that have value. And I mean, I'm not going to name names because I'm not an investment advisor, but there are companies even in the Permian Basin. There's a couple of companies that focus just on Permian Basin, and their balance sheets and income statements don't look too bad. They're not making money, but if they're holding their own at $45, that's pretty good. So I just encourage people to look beyond the hype. Get on Google Finance or Yahoo Finance and just look at those cash flows. It's available to everybody. That'll tells me a lot. I mean, maybe Wall Street doesn't care about cash flow, but I do. I'm a dinosaur maybe, but a company that's getting by and has good assets in these times in the oil business, that's probably not an exciting winner, but a winner in my book. So.
Well, I want to thank you again for your time today, Art. And if our listeners want to follow more of your work, how do they do so?
artberman.com. It's a website. It's mine. There's no paywalls. There's no advertising. It's just information, and that's where you ought to go. And everything that I write about is out there. And you can follow me on Twitter too. Arthur Berman 12, and I tweet out something every day with something that I think is interesting or important, and that's the best way to find me.
Excellent. Well, thank you again for your time, and I look forward to discussing the oil and energy markets with you in the future again.
Yeah, me too. It's been a great conversation. Thanks for your good questions.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALLSTFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street for Main Street.